let's get started with understanding liquidity, understanding how the market is moving. So first of all, I am sure that you've seen in the chart something like this. So for example, we have support and resistance. Keep in mind that I'm not actually using support and resistance, but let's just make an example on how your retail traders are trading. I mean, we are all retail traders, but we try to follow, the movements of the banks and follow some of the concepts that the banks are using. So let's say, for example, we're going sideways, and you try to short right here. So you're trying to short, enter a sell right here, and the price just goes straight to the upside. And this is fine. You're starting to think that this is a breakout, and therefore you want to enter on the break and retest, okay? You want to enter on the break and retest. You enter a buy right here, and then we just go straight to the downside, breaking all these lows and just go straight to the downside, and you get two losses, and you don't understand why you sold at resistance and you got a loss. Then you have a breakout, you're trading your break and retest strategy, you're entering right here, perfect entry according to your strategy maybe, and then you get another loss. And maybe you're not understanding why. Oh, well, other than this, you're not understanding why this is happening. Same thing is that maybe you have a trend line, you're trading only based on trend lines. There's nothing wrong with trend lines, that just need to be used in the correct way and together with the right, with other things. We cannot just use trend lines. So we're trading with the trend line, you're trying to enter a buy right here, and then you have this nice move to the downside. Therefore, first of all, you probably entered a buy from here and got a loss. Then maybe you had also, I don't know, Fibonacci confluence or whatever, and still got a loss from there. Then you understand that this is a breakout. You try to trade the break and retest. You enter a sell from here. Maybe also you see some sideways movements, some nice rejections with some, pin bars, and then we just go straight to the upside. This is because the market is, creating liquidity below this trend line, and now above these levels, they are just, accumulating a lot of liquidity in order to grab this liquidity, because a lot of people need to lose money in order for other people to make money. So the banks need to make money, and they need a lot of retail traders to actually lose money. They know how the majority of traders are trading. They know where the majority of traders are looking to enter trades and where they're placing their stop losses, and therefore they grab these orders and then they make their moves. And in fact, after this accumulation right here, where a lot of people are just entering sells, adding sells right here, entering sells all over this place, because they see, they see the confirmation that there is a break and retest and some pin bars, some rejections from this area. They enter sells, and then we just go straight to the upside, maybe with just one huge candle to the upside. This is because we accumulated a lot of liquidity right here. Above this level, there were many stop losses, stop loss right here. And with one move, maybe just one candle, we just moved straight to the upside, grabbing all of this liquidity. So where is liquidity lying? So usually we have to take, double bottoms, double tops, equal lows or whatever, and trend lines, and we can see pretty much where liquidity is lying. So above these highs and below these lows, there is probably liquidity right here and liquidity right here. And in order for the market to move, what we will see usually is actually a grab of liquidity in either one direction or the other before taking the real direction. Now, this is a concept that I teach a lot in my course, especially for entries. We look a lot for these things for entries. We have, a particular list of things which we need to look at in order to enter trades. But for now, we will just understand what the market is doing with liquidity, where the liquidity is lying, and some examples. So also right here, this was EuroCAD. EuroCAD, we have a nice support. I'm not using support, but I'm just telling you how the majority of People are actually trading. We have a nice support is established. Now with a huge move to the downside, we are grabbing the liquidity below this level. This doesn't mean that we are turning bearish, because we're not. This is not a break and retest for continuation to the downside. This is just a grab of liquidity. Right now we are accumulating, just going sideways, and we will see where we are headed next. Of course, therefore, below this level, right here, below this double bottom and support, there was liquidity which was grabbed. So keep in mind that the market, the banks and financial institutions need to grab liquidity before making any move. Now, if I zoom in, for example, another example from the top right here was that everyone maybe was entering sales here, was entering sales. We have the move to the downside. Finally, everyone moves stop loss at entry, or maybe their stop losses were just above this level, because when you enter a sell, you probably put your stop loss just above the previous highs. So they maybe got profit, and maybe they are right about the direction of the market. The market is actually bearish, and in fact, we continued bearish after. So I'm not saying that you're going to be wrong 100% of the times. I'm just saying that even if you're right, the market wants to stop you out before actually taking that direction. The market wants to grab the liquidity before making the real move. And in fact, what happened was that went to profit, whether you had your stop loss above the highs or at entry, because maybe you made the trade risk-free, what the market wants to do is come back, take the liquidity, whether it is at entry or at the stop losses above these levels, and then continue through downside with some huge movements. And as you can see, this is what happened. And liquidity was lying just above that level. Cancel these things, and let's move to some other pairs. See if we have some good examples. All right. So also, every time you see a trend line, we have liquidity above the trend line level. We have this trend line, for example, I don't know, this trend line in the beginning, we grab liquidity, continue to the downside. Same thing, this trend line, grab liquidity, continue to the downside. Now we have this trend line, and this is the reason why I don't really use trend lines that much, but I use them in confluence with other things in order to understand the direction of the market. Because same thing right here, are you going to buy right here GBP CAD because we had a small breakout on, I don't know, the 15 minutes time frame? This is a breakout, a retest, whatever, for a continuation, or are you going to short because we are touching this trend line and maybe you think this is a fake out? In this case, I'm just not looking at trend lines, so there is no real answer. You just gotta keep in mind that the market knows that we are entering sells, and therefore there is liquidity all above this previous highs, all above this highs, there is liquidity, above these highs, there is liquidity, and the market actually wants to come back to grab that liquidity. I mean, this doesn't mean that we will just go straight to the upside, but at the same time, not many traders can win. I mean, as you know, 90% of traders are losing money, and the reason why they're losing money is because the market doesn't want you to win. Therefore, you will grab liquidity, will actually stop you out before moving in that direction.